Good morning, everybody. I want to welcome you to today's webinar and thank you for your participation. I know from the list of participants, we've got a large group of participants from across the US and I believe in some cases from outside the US. So thank you to everybody for joining and taking time out of your respective busy schedules. My name is Ray Dunning. I'm part of the team at Wealth and Legacy Group. And as you know from the invitation, Wealth and Legacy is sponsoring to today's webinar. I'll act as the host and facilitator and guide us through to today's discussion. As you know from the invitation, the subject matter is punishing successful families, a subject matter which we think is both relevant and thought-provoking. And I know we have a very full agenda for you, so we're looking forward very much to the discussion and your participation. Before we get going, I just wanted to mention a couple of very important housekeeping matters, which we will adhere to as we go through today's presentation. First of all, just to confirm, this will be an interactive discussion, and so we'll encourage all of the participants to ask questions as we go through the formal and prepared comments. There'll be two ways to ask questions. One is through the chat room, in which case we'll receive the question here. One of my team will give me the question. I'll ask it on behalf of the participant. Or if your preference is to ask the question live, you can raise your hand on the screen. We will introduce you. We'll open up the mic, and if you could just let us know your first name and first initial of your second name. The webinar will be recorded, and we will distribute a copy of the recording to everybody after today's webinar. And lastly, I will follow up with everybody just to make sure that we've answered questions, there are no issues outstanding, and really for us just to stay connected with you all. Let me take a couple of minutes to introduce our speakers for today. And firstly, I have the pleasure, I'm honored to introduce a true legend. Richard Harris is considered by many, and that's not just me, but many to be a leading expert in the life insurance industry. By way of background, Richard has an illustrious 50-year career as a life insurance consultant, a forensic consultant, and an expert witness. In addition, he has spent numerous years with numerous attorneys, accountants, trust officers, and family offices navigate through many nuances and complexity of life insurance. His accolades and accomplishments, as you can imagine, are extensive, too numerous to get through today. He's written numerous articles of which many of you will probably be aware. But I would say, relevant to today's discussion, that Richard is the chair of the Insurance Committee, Trust and Estates, and also a member of the Editorial Advisory Board. In addition, Richard, and we are honored, but Richard is a member of the Wealth and Legacy Advisory Board. Chad Reyes is the co-founder and CEO of Wealth and Legacy Group. Chad has spent over 20 years continuing to serve highly successful entrepreneurs, industry leaders, and generational families to protect and transfer wealth to future generations. And as an understudy of Richard, Chad is actively involved in developing tax evasion strategies to our many and mutual clients. Before we get going, and I'm going to hand this off to Richard, I just wanted to kind of set the scene, if you will, and ask Chad from his perspective to give us his views in terms of why this subject, punishing successful families, is so relevant, particularly given today's markets and environments. Chad, if I could pose that question to you.
Yeah, thank you, Ray, and excited to be with you guys today. You know, the idea, when we came up with this idea of punishing successful families, it's kind of crazy, because don't you feel like sometimes no matter how successful you are and how much taxes you pay, there's always another element of taxes. And I think this is so key. You know, Richard and Ray and I were talking about, guys, I'm getting an echo. If we can mute on that side. But so Richard and I were talking before this, thank you. And I think it's so important right now where we are in the world, because, you know, taxes, we're seeing potential tax law changes everything we see looks like the tax laws are going up, right? And I know for a lot of our clients and a lot of the families that we are constantly in communication with is how do we navigate this? And what we're going to be talking about today, which is around, how to utilize a time-tested strategy of life insurance, but how do we utilize it for successful families to reduce their tax liability from an income, from a capital gains perspective. And even some of the conversation today, we're going to even talk around estate taxes and how to use it for that planning tool. One of the things that I think is so key is that in this world of PPLI, there's been a huge change in the model over the years, where it used to be families that were uber wealthy that would be using this contract, and then over time it's gotten to where families that have success, but maybe they're not that level of billions of dollars or hundreds and hundreds of millions of dollars, are now using these types of contracts. And Richard's going to be sharing some about that. So just kind of wanted to share that sometimes we think about the old product when it originally came out many years ago. And Richard had written an article in 2004 around the concept that we're going to be talking about today. So he's super well versed in this area. But I think in the world that we're living in today, we need to look at how to effectively manage our clients' portfolios. And from Wealth and Legacy Group, none of us are licensed to manage any investment portfolios. So we work with our clients and their advisors to help them utilize this type of strategy. And the last part I want to talk about is the efficiency of a portfolio. I don't know about you, but I know when I look at our own portfolio, or I look at our clients and when we're working with them on some of these types of planning, sometimes when we want to get out, meaning we want to sell a position, it's maybe not the most opportune time. And sometimes we stay in because of the tax ramifications. I mean, I've seen that all too often, and I've heard that all too often. And the strategy we're going to talk about today gives us the ability to be able to navigate without having to trigger these tax events. So I'm excited about this, Ray. I think there's never been a more opportune time, because right now, even though it may seem like taxes are so high, we're really in one of the lower tax rates in recent history. If you go back and look over the last 50 years, which is hard to swallow because it seems like taxes are just everywhere and kind of consuming up everything, along with inflation, as we're all experiencing. But this strategy is going to help mitigate a lot of that. And Ray, I'm going to kick the ball back over to you, and let's jump into the discussion today. So I'm just excited, and thank you guys. Before we do that, though, one last thing. I do want to take credit for the Superman hero picture that's on the screen. So when we were preparing this, Richard, with all his experience and years of experience, he's so humble about it. But we said, Richard, can we do this? And he said, sure, no problem. Put the picture up. So he is an industry legend, and we're blessed to have him on our team. And I think you're going to hear so much valuable information from him that'll help you, your family, and moving forward. So with that, Ray, handing it back to you.
That's great. Appreciate that, Chad. And the subject matter, as Chad mentioned, is so current and thought-provoking, and we know we have a very broad section of participants representing wealth advisors, families, individuals, investors. So we know we've got a very active and very relevant discussion. So with that, I'm going to hand it off to Richard and ask him to kick off the formal discussion. Richard, over to you.
Well, thank you. There are a couple of clarifications I'd like to make. The reason Chad decided to put the Superman costume on me is because the headshot that I have is cropped and it would fill up the screen, and it would look silly compared to the photos of Chad and Ray. So he put the Superman costume on it, and I said, considering the alternative, it's okay. I take exception to being called a legend for two reasons. Legends are either myths or they're dead, and I'm neither. So I just want you to be aware of that. Now, to start it off, rather than talk about private placement life insurance, it's more important to talk about what it does. And private placement life insurance is like an unlimited Roth IRA. And in a Roth IRA, you're aware that the money grows on a tax-free basis, tax-favored basis, and you can withdraw money without having any income taxes. Now, with some explanation, that's what private placement life insurance does. The caveats are that in order for you to be able to invest in a private placement life insurance policy, there are costs involved, and the costs run, depending upon the amount of money, anywhere from 70 to 100 basis points. So the first thing I talk to clients about is, if you're considering this strategy, a way to look at it is look at the value of your portfolio, take 1% of that, and if you're paying that or more in taxes, then you should be considering private placement life insurance. Private placement life insurance is also good for a portion of your portfolio that's not tax efficient. For example, if you have a bond portfolio that's not tax efficient, private placement life insurance is excellent in that regard. So private placement life insurance, in broad terms, one, it allows you to put in as much money as you want, as opposed to a Roth IRA. And two, it allows you, if properly structured, to access funds during lifetime without any income tax consequences. And I'll get into that as we go through a description of what private placement life insurance is about. Ray?
Thank you, Richard. And a great way to introduce the subject is comparison to a Roth IRA. Perhaps for the audience, Richard, you could expand a little bit on what the rules are as it relates to application of this solution.
Okay. Well, the reason that it involves life insurance, and I like to avoid that term as much as possible and focus on what it does and how it works rather than what it's called. Because if you put in the words life insurance, that people suddenly, they're like deers in the headlights. That's the end. That's all they hear, and we can't go any further. The reason it's life insurance is because there are actual laws in the tax code that specify what life insurance is and how it works. And if you have a policy that is considered life insurance, two things. One, the inside buildup of the cash value is not subject to income tax. And the second is that when somebody dies with a life insurance policy, the death benefit is not subject to income tax. So it's like getting an automatic step up in basis. Now, as far as rules go concerning life insurance, one, in order for it to be life insurance, there has to be a death benefit involved. And for those of you that want to dig deeper, and I don't really want to get into the weeds with this, Section 7702 of the Internal Revenue Code covers all of this. If it is considered life insurance, there are two ways that you may fund it. One is in a lump sum, and two is in periodic payments. If you fund it as a lump sum, it creates what's called a modified endowment contract. And the reason, known in the industry as MEX, MEC, the reason that it's important is that a modified endowment contract except for the death benefit, is taxed like an annuity. An annuity has, if you take money out either by loans or withdrawals, if you have any gain, gain comes out first. Gain comes out as ordinary income, regardless of whether it's capital gains inside the annuity. And if you're under 59 and a half, there's the potential, unless you take level payments, that there's going to be a 10% penalty tax. Well, that's the same if you put a lump sum money in. Now, clients do this because they expect that they'll have no need for that money going forward, and they want to get it working for them as quickly as possible. The death benefit is still income tax free, so that even though if you take money out, you have an income tax consequence, when the individual who's the insured dies, then the death benefit is not subject to income tax. If you pay money in over a certain number of years, generally 4, based on the rules of engagement, as 7702 is, they call it, that it's not a modified endowment. And that means 2 things. One, even if there is a gain, you can withdraw up to the basis, and the basis is whatever the amount of money is that you put in. Same as the basis in a stock or any other investment. 2, you can take loans. So you can withdraw the basis and then take loans, or just take loans. And the loans are not subject to income tax either. So it's possible to take money out of the contract during the insured's lifetime without having to pay income tax on the money that you take out.
Richard, if I could just stop you there. We've got our first question in from the chat room. So thank you to Dave F. The question is as follows. Are the rules regarding how much you can invest in life insurance to avoid a modified endowment contract?
And the answer is, and hopefully I gave the explanation, if it's paid in over a certain number of years, and I don't want to get into the weeds, the technicalities of 7702, but if you pay the premiums in over 4 or more years, it's not going to be a modified endowment contract. If you put money in 1 year, 2 years, and possibly 3 years, it's likely it will be a modified endowment contract. I hope if that doesn't answer the question, please let me know.
Thank you, Richard. Dave, let us know if there's either follow-up or second part of the question.
Now, there are rules about private placement life insurance. And the first thing I want to clarify is that the owner of the policy does not have to be the insured. So if you have somebody that is in bad health, is older, or whatever have you, they can have siblings, children, grandchildren as the insured, and they still own the contract, so that you get the benefit of not having to pay anything extra or a higher rate to the insurance company for the death benefit. The death benefit is called the cost of insurance. And that benefit is calculated, as it is in any other universal life contract, as the difference between the face amount of the policy and the cash surrender value of the policy. So if you have a $20 million death benefit and your cash value is $10 million, you're only paying for insurance for $10 million worth of insurance. Secondly, in the cost, there's what's called, there are administrative fees, and that's charged by the insurance companies. And for the most part, we're working with known insurance carriers, well-regarded insurance carriers, such as Prudential or Pacific Life or John Hancock. So you're dealing with those. The private placement life insurance, your money is considered a separate account. And that means it is not an asset of the insurance company. So regardless of what happens to the insurance company, your money is still secure. It's not part of the insurance company's assets. So that's very important to note. Now, there are certain third rails that you have to avoid touching. One is that the money going into a private placement life insurance policy, it has to go in cash. You can't generally put it in kind. And even if you can put it in kind, if there's a gain, the gain is immediately realized when you put it in. Two, you can't control the investment, investor control. So usually, if you have a piece of real estate, you can't have the PPLI, and that's, you own that, and you're the manager. That's investor control. If you have a business interest and you're the owner, the manager, or what have you, that also is investor control. And lastly, there has to be diversification. And diversification generally means that no more than 50% is invested in one asset, and more than 30% is invested in two assets, and more than 20%, et cetera. The ways we get around that are two. One is called an insurance dedicated fund, otherwise known as an IDF. And the insurance dedicated fund is a look-through. So instead of looking at the insurance dedicated fund as one asset, you're looking through the underlying investments in those assets. And in the commercially available private placement life insurance policies, a lot of what's available are offered by companies that you already know in the money management field: Vanguard, Fidelity, American Funds, etc. Also available are hedge funds, non-traditional investments, and some are available directly where they already are in the policy. If you have a hedge fund that you use and they're willing to go in, they can either become an IDF or set up an LLC, which is, again, an LLC setup allows for the look through to the actual assets and put that into the private placement contract so that you pass the diversification test. A third thing that's coming to the fore today is if you have managed accounts. You have money managers that are running money for you, stocks, et cetera, et cetera. Depending on the amount in there, 2 million for some products, 5 million for most products. If that's the amount that they're running, you can set up a separate LLC for that money manager, specifically to manage your money, so that you have an individually managed account within the private placement policy, so that you can get the benefit of the tax savings and still have the money managed. Again,
Richard, can I interject for one moment?
Yeah.
I just want to share one thing, because I think what I've heard over the years is people, they hear insurance and they think that, well, okay, well then I have to manage, your firm is managing that. But that's not the case here. I just want to be clear so everyone understands that one, we don't manage money, but two, your wealth manager, your family office, your hedge fund continues to manage those funds. This just becomes a vehicle to get more tax efficiency when you put the insurance around it. So I just wanted to be very clear on that.
And if you're using an LLC, there's the money manager gets their fees in full. and there's no add-on to their fees because it's in private placement life insurance. So you have the ability to have managed money inside a life insurance contract, and it depends upon the insurance contract. Now, assuming that you don't have control, and in the money management area, you can't tell the money manager, I want you to buy this stock. That now becomes investor control. You can have an asset allocation program, and that asset allocation program, within that asset allocation program, the money manager will choose assets, and you can change the asset allocation as you can with the money manager under normal circumstances. If the money manager is using alternative investments, the alternative investments can be in that individual account. The caveat there is that the money manager or whoever has the money has to report the value of the assets on a quarterly basis to the insurance company so that they can report the value back to the owner of the fund. So that's a requirement. The hedge funds that are in private placement policies today do that, and they're already aware of that. So you have to be aware of that. And as you can see, the other thing about private placement life insurance, private placement is exactly that. You don't get an insurance policy. It's a private placement memorandum. Also, because it's private placement, the pricing is institutional. So, for example, if you were to buy a life insurance, commercial life insurance contract, their pricing will be their cost of insurance, all in, everything, maybe 150 or 200 basis points. Here, all in, the pricing will be between 70 and 100 basis points. And everything is disclosed. There's nothing hidden in a private placement life insurance contract. And there's nothing hidden so that you're aware of all the moving parts. Now, apart from the administrative fee that the insurance company gets, the two other moving parts are the cost of insurance and what's called M&E, which in reality is where profit comes from, and that is based on basis points of the value of the assets in the private placement policy. And there is some negotiation ability there. Certainly, the more money that you're committed to putting into a private placement policy, the more negotiating ability you have as far as expenses go in the contract. Now, I am a principal in an M Financial firm. Some of you may know who that is, what that is. Others of you may not. Why it's important is M Financial has their own private placement policies with Principal, with Prudential, and they're not available through any other purveyor of life insurance other than people that are members or affiliated with M Financial. Why it's important is twofold. One, M Financial reinsures part of that, and the cost of insurance rate is the cost of insurance rate that M Financial uses. Now, M Financial clients are very high net worth clients. And very high net worth clients have the financial wherewithal to take care of themselves regardless of circumstances, and are generally more attuned to taking care of themselves in general. What that means is that the life expectancy of those people is generally longer than the life expectancy of the normal life insurance company's client, which means that the cost of insurance inside a product that's available through M Financial, and they're called Magnastar, is usually lower than what you could get in a regular private placement life insurance policy. Secondly, M Financial, the carrier cannot do anything about their expenses, their M&E, or they can't change the cost of insurance unless M changes it. And the only changes M has ever made is to lower the cost of insurance. If their mortality experience is better, they have lowered it. They've never raised the cost of insurance. So M has a certain amount of control, which gives you leverage when you're dealing with M products because they have leverage, according to the products.
Richard, if I could just stop and ask another question, came in through the chat room. And I thank Dave F. for the follow-on question. You actually covered some of this in some of your earlier comments, but I think it's worthwhile just revisiting and confirming. And the question from Dave is, do we work with a number of insurance companies, carriers for this product, or are there only one or two that offer this type of solution?
No, there are a number of carriers that offer the solution, and we generally can work with most of them, including non-traditional offshore carriers. Some of that may be important for foreign nationals because of certain tax laws in the US and getting certain tax favored treatment. The other is that we're able to pick the product that's best for the individual insured. This is
Richard,
bespoke planning. And before you begin, Chad, I just want to say one thing about questions. The only dumb question is the one that you don't ask. So if you have a question, please ask it. Chad, go ahead.
yeah, no, that's a good point. You know, I think a lot of people sometimes they hear, they hear about these type of strategies, but they're not necessarily very familiar. But there is no dumb question. But I wanted to share this, and maybe you want to talk to this a little bit, Richard. I know you and I have spoken with one specific carrier who will kind of design the death benefit to ratchet up or down depending on the need of that family. And I think that's important because when most people think of life insurance, they think of it as an insurance product that's kind of off the shelf, but there are ways to increase or reduce death benefits depending on the time of that contract. Maybe you just speak to that a minute.
Yeah. Again, I don't want to, this is getting into the weeds, but there is one carrier that we work with that's offshore, but is US compliant. As a matter of fact, the people that own the carrier are based in Colorado, but there's one carrier that can do things regarding death benefit that other carriers can't. They can postpone the death benefit coming in until a later date. It's agreed upon at the time that you do the contract as to what that date is, but in effect, you're going to ameliorate your insurance costs in the early years. The other thing in design is usually these are designed to go up to the modified endowment contract limit. And what that means is we're trying to buy the least amount of insurance for the dollar. And the reason we're doing that is because the insurance creates a drag on the earnings on your return. And we want to make sure that that drag is minimal. So that's one of the things we look at in doing that. Another thing is in the design, depending on the carrier, there are different minimums. Minimums generally, if you're going, you're going to use more if you're going to use a product that already exists with investment options that already exist, and you're going to use those investment options. And by the way, some of those investment options are debt related investments that have done consistently very well. Then your minimum is generally $2 million. And that can be put in over a number of years. So when we talked about paying over 4 years, you can put in $500,000 a year. With one exception, if you want to have your own money manager managing the money, the minimum will be $5 million to set up that account. So want to explain that part of it. Right?
Yes. Am I unmuted? Richard, if I could just ask, just on this particular aspect of minimum amounts, minimum investable amounts, you mentioned in some of your earlier comments that unlike the traditional Roth IRA, there are no limits. This solution for using life insurance is effectively unlimited. Considering that, how does it work in terms of how that risk or that coverage is placed with more than one insurance company? In other words, are we using a kind of a reinsurance concept of using multiple carriers for the larger amounts?
Well, those are very good questions. And the amount of insurance available to any one insured and their second to die policies or any two insureds is limited based on the insureds. So the maximum amount of coverage may be 200, 250, or 300 million on any one life. However, you can have multiple lives insured, as we discussed. Also, without getting into any detail, there is a private placement life program available where you can put in multiple billions of dollars and not worry about reaching the insurance company's retention limits. So each of these is custom designed. When I work with a client or my firm works with a client, we want to find out what you're trying to accomplish, what your parameters are for doing this, and first determine, A, is private placement the right vehicle for you or not? We don't want people going into private placement. If you're invested in municipal bonds, you don't want them in a private placement life insurance policy. So it depends on the investments. We also want to tailor this to your specific needs. And so have you understand, we're educators, we're not salespeople. And we want you to understand as much as possible so that the client can make an informed, client and their advisors can make informed decisions. One point though, there are people that are specialists in private placement life insurance, and there are people that sell life insurance in general. And the people that sell private placement life insurance and know what they're doing is a very, very small subset of all the people that sell life insurance.
Yeah, no, that's a very good point, Richard. I wanted also to go back, and I'm trying to keep the flow going here, but I think you mentioned again something which is important perhaps to just go back and reiterate. You mentioned that the owner and the insured don't necessarily need to be the same individual. Could you just explain from your experience what the kind of eligibility criteria would be if in fact there was a differential between the owner of the policy and the insured?
There is an eligibility criteria, and the eligibility would be siblings and lineal descendants normally, people with whom you have an insurable interest. And as it's defined by the states as to what is an insurable interest. If you have a business and there are other officers of that business, you can use them because there is, again, you have an insurable interest in those. So those are generally the groups that you have to choose from. So it's quite extensive, so that we're going to look for the healthiest life or the healthiest lives that are going to produce the highest return for the same dollar. And that's how we're going to structure this.
Thanks. And I don't want to dominate the questions here, but I just want to keep the dialogue going, because you talked about a number of the things, including the rules, including the cost variability, minimum amounts, tenor, etc. I just wanted to expand this discussion a little bit and ask, and perhaps even Chad to join in here. How is the application of this solution as it relates to estate planning?
Well, first of all, normally this is done for income tax planning. That being said, we have a lot of clients that are trusts, large trusts that have a lot of money. And trusts are taxed at the top tax rate after, I'm exaggerating, after they make $5 of income. I think the real number is about $13,000. So they're taxed at the top tax. You have Medicare taxes as well to deal with. So if you have an existing trust, the existing trust, which is already set up to be out of estates, and if it's a dynasty trust, it's not going to be subject to estate tax, you can have the trust purchase the life insurance policy. If you want to use this for estate planning purposes, if you haven't used your annual exclusion, your lifetime gifts, and you're willing to use those to fund, you have up to, currently, husband and wife, up to $22 million that you can use to fund the gifts. If you have, like a lot of people that we work with in this area, have used those for other purposes, then there is another way to set it up so that the insurance policy can be in a trust. And this is through a personal loan from the individual to the trust. Now, there are regulations to the Internal Revenue Code that specifically address these types of loans. And these types of loans are different than any other type of loan that an individual can make to another individual. For those of you that may know, those types of loans are governed by Section 7872 of the code. For loans to purchase life insurance, there's regulation 1.7872-15 that specifically governs loans to life insurance. And it's very, very good. It has benefits to it that the other section does not. One benefit is that you can make a loan for the life of the insured. If you're making a personal loan to a family member, it's going to be a term loan, and the term is going to have to be reasonable, including reasonable based on your own life expectancy in terms of getting repayment. I mean, sometimes, you can get into, there are other things you can do, such as self-canceling installment notes that may be okay, or even private annuities where you're transferring property. But just in general, if you're making a loan, you're subject to those terms. I'm an accredited estate planner, so I'm familiar with the other techniques that attorneys use for estate planning. In this case, one, you have a loan that can be for the life of the insured. And if you make a lump sum loan, whatever the rate is at the time you made the loan is going to be the rate for the entire life of the loan. It's not going to change. Now, there are...
Richard, just for one moment, though, I just want to point this out because I think it's important for everyone. Because of the rate, the environment that we're in, kind of when I spoke earlier, right? We have rising tax rates, but because of the rate we're in too, that loan gets locked in not just for a 9-year period of time or a 12-year period of time. That loan could be, what's the longest loan you've seen locked in for a transaction like that?
A loan for the life of the insured. And if you're insuring a 20-year-old, that loan is going to be for a very, very long time. The youngest age that I've done this strategy for so far has been age 35 as the insured. Now, what the IRS says, they have what are called applicable federal rates. And applicable federal rates determine the minimum interest rate that has to be charged in order for you not to get into an income and gift tax situation. And they have what's called a short-term rate for any loan under 3 years, a midterm rate for loans between 3 and 9 years, and a long-term rate for any period after that. Now, if somebody has a life expectancy, according to the new government tables, of longer than 9 years, the rate automatically defaults to the long-term rate. The rate for April, is it April or March, is 2.14%. Now, that's your bogey. So in order for that to make sense, you have to anticipate that your investment performance is going to be greater than 2.14%. In the very early years, and actually until somebody is much, much older, 85 or 90, there's going to be an amount of insurance in addition to whatever the value of the account is. So basically, that gives you arbitrage. So if somebody dies and the value of the sub-account, the loan is $5 million, the value of the sub-account is $10 million, but the face amount of the insurance is $20 million. You only have to repay the $5 million at death. So that means $15 million is going out. Generally, most people will say that they're very happy to arbitrage that particular rate. So you have the benefit of a loan for the life of the insured where the rate is locked in forever. The second benefit you have is that if you make certain representations on your income tax return, and they're spelled out in the regulation, and they're very simple. The representation is that it's the intent that the loan, not the interest, just the loan will be repaid. The IRS must respect it as a loan. And loans under 7872 are loans for all federal tax purposes, gift, income, and estate tax purposes. So you can bind the IRS to this. You can accrue interest, which normally you wouldn't do in another type of loan, and this is specifically allowed. If you're loaning to a type of trust called a grantor trust, which basically means that the person, the grantor, has certain powers in a non-fiduciary capacity, such as being able to replace assets with assets of equivalent value. All the income tax consequences flow to the grantor. What that also means is that there is no income tax consequence to the grantor when you're accruing interest as long as the grantor is alive. So that it doesn't create an income tax problem. The year the grantor dies, it will no longer be a grantor trust, and then you will have to make other arrangements for income taxes. But up until that year, and for that year, if grantor is the insured, for that year only, there will be some interest that will be subject to income tax to the grantor. But otherwise, it's not subject to income tax. So these are special features available through this regulation that are not available to any other type of related party loan. So using that type of loan, you can make a loan to the trust secured by the cash surrender value, just the death benefit, which is allowed, or both, and it will be considered a loan. There is some bookkeeping involved, keeping track of if interest payments are being made. It has to show that the interest payments are being made at the right amount. If interest is accrued, each year you have to stipulate what the accrual is, and you're going to have to file that with your income tax return to apprise the IRS of what's going on. But that's a minor inconvenience, and it doesn't in any way allow the IRS to stick their camel's nose inside the tent to somehow unravel this.
Richard and Chad, I just want to jump in very quick and just reach out to the audience. We've been tracking incoming questions, but I did want to reach back to the audience and just remind them that if they did have a question, either put it in the chat room, we'll receive it and ask the question. If you want to ask live, let us know, we'll open up the mic. I also wanted to use this as an opportunity to give Richard a breather because he's been talking continuously. And I know, Richard, you said many times that you didn't necessarily want to get into the weeds, but I think we've had to unpack some of the nuances and complexities of this solution because hopefully it's evident that this is not a one-size-fits-all. It doesn't apply to every situation, but with the right facts and circumstances, it is a very effective and tax-efficient solution. So I just want to reach back to the audience again and just remind them that if they have a question, we'd encourage you, chat room or live. I just wanted to take a quick time out and then we can finish as we close in on the discussion. Em, is there anything else coming up? No.
And Ray, while we're waiting on that, I think it's important to reiterate that we will certainly be giving this recording to everyone as well, so they'll be able to go back on that.
And pardon me if I steal your thunder a little bit, but after this, I, through Ray and Chad, will be available for any one-on-one discussions that you'd like to have.
Yeah, absolutely. I just want to check one more time with my colleague Emily, just to make sure if we've got any questions being screened. No.
Well, that means either of two things. Either I've done a very good job or I've put everybody to sleep. Hopefully it's the former rather than the latter.
Absolutely. In fact, let me ask Chad. Chad, if I could ask you a question, because we've talked about a lot of process and technical details, terms of the life insurance solution. Maybe a question to talk about what does implementation look like, the application part, the transactional side, if an investor or an individual wanted to pursue the transaction, what does that back-end process look like?
Yeah, so there's a process that we use, and Richard, jump in at any point as you like, but the key is, and Richard had mentioned this earlier, that because this is not off-your-shelf life insurance, so if you look at a traditional life insurance contract, something that you bought over the years, like a whole life or traditional universal life, you can't negotiate that stuff. You can negotiate for a better rating, but you're not negotiating typically that type of contract. And in this, really understanding the nuances is really important, because what you're doing is you're designing some form of a custom tailored type insurance strategy.
Chad,
So
I jump in. I forgot one
yeah,
very important thing.
yeah,
Every state has a state premium tax on insurance, including life insurance. Generally, those taxes, when you're buying a commercial policy, the insurance company has cooked in the cost of the state premium tax, generally at 2%, and regardless of what state you buy the policy in. However, here, you can choose a jurisdiction by either the LLC or a trust or some mechanism to choose a state that has a very low premium tax. For example, instead of 2% coming off the top of the money you put in, we often use South Dakota as a jurisdiction. There are administrative trustees there that do nothing but administer trusts. They don't have any investment say, they don't do any assets under management. And their state premium tax is 8 basis points.
big difference.
So because it's private placement, we have the ability to choose a situs in conjunction with the client and only pay the state premium tax to that situs, rather than what the insurance company normally does is they load the contract anticipating a certain percent is going to go to state premium tax.
Yep. Yeah, no, Richard, that's a really good point, because in that whole custom design side of it, you're really designing what works best for that client, for that family, and the negotiating side of it, So I think, as Ray, to answer your question, I think as you're building a life insurance contract, especially in the PPLI world, Richard alluded to it earlier, how important it is for people to have experience, and he has more experience than most people in this world, in this industry. But it's really understanding who are the insureds. Is there an insurable interest? Then making sure that we've identified what are the assets that we do want to utilize to go into this type of strategy, and then negotiating and getting a product that we feel comfortable with, that would accomplish your objectives, and then ultimately finalizing the portfolio and then funding it. So I'm kind of giving it very simple. I'm simplifying the whole process, but that's really what it looks like. And it's the negotiation part of it and the packaging side of it is a key part of it, though. Especially when, Richard, you spoke about something earlier about larger families and larger blocks of insurance. It's important to make sure that that's all coordinated correctly, because they're all going to typically the same reinsurers. So when reinsurers start seeing multiple people approaching for the same family or the same insured, it raises a red flag. So you want to be careful about that. That's why the design is so key.
Red flag. If you go to one insurer and you don't tell them what's going on and you don't limit what they can do, they can go out to the reinsurance market. Once they go out to the reinsurance market, none of the other carriers that you may want to deal with can go out to the reinsurance market unless they release it. So for large cases, you can't do a proper job unless you're managing the whole process, including capacity and reinsurance, so that you don't run into that issue and you have the whole market to deal with.
Richard and Chad, I have another question in through the chat room, and I'm going to apologize in case I'm mispronouncing the name. I want to make sure I read the question correctly. But Anna Ree L has asked the following question: if there are appreciated assets within an LLC, can one loan in the interest in the LLC to a policy? If I need to repeat that, Richard, I will be happy to.
No. This gets very technical. The short answer is no. Any transfer of the interest, either by loan or outright to the policy is a taxable event. However, there are strategies that are available where you can use the assets cash flow through the loan arrangement to pay the premiums for the policy. But you can't take an appreciated asset. If you're contemplating this, one, I would suggest, if you have appreciated assets, then I would certainly suggest not putting, and you need to liquidate them in order to go into this. You probably don't want to do it all in 1 year. Maybe, maybe not. But regardless of whether you do or not, you may not want to pay the premium all in 1 year. So if you don't want to pay the premium all in 1 year, you may want to liquidate the assets over the same period of time to defer taxes on whatever you can to a later date.
Got it. Thank you, Richard. And Anna Marie, I hope that answered the question. If not, please let us know. I'll just ask the audience again if there are other unanswered questions. We're just a bit above the top of the hour, so I know Richard's been talking extensively. If there are other questions, please let us know through the chat room or live.
Yeah, please do it quickly because I have to go into my closet and change into my outfit to save the world.
Those were the unprepared comments for the audience, but
hey Ray, I just wanted to share also for those that are part of the Family Business World, the Family Business Magazine, we will be at their event in September. So we'd love to connect with any of you that are out there as well. The conference that they're having in Chicago, we're one of the sponsors there. So we're certainly looking forward to connecting with you. If you are out there, certainly connect with us. We would love to, at least connect the dots of, you joining us and us knowing who you are.
Absolutely. Great point, Chad. Thanks for reminding me. So look, if in fact there are, and I've just checked, there are no other outstanding questions, I want to thank Richard in particular and Chad for joining me in this discussion. I had the easy part by hosting and facilitating, but I think as Richard discussed through the presentation, there are some extraordinary nuances in this solution, and I know that was an hour plus of discussion. So I just want to encourage the audience, the participants, in closing out this session. One, just thank you again for taking time. We know how schedules are busy, yes. So to devote an hour, thank you very much.
Thank you for putting up with Chad.
We hope you agree that it was thought-provoking. It's a very relevant, it's a very topical subject. We hope you got something out of it. But as I said at the top of the discussion, we will be sending out a recording of the presentation, and I will be reaching out to each of you just to follow up in the event that there are unanswered questions, additional information. As Richard said, we'd be happy to set up follow-up calls as necessary. But maybe with that in mind, I will just formally close out the webinar. Thank you again for each of the participants. Thank you, Richard. Thank you, Chad. And I wish you all a very, very blessed day. Thank you all.
Thank you.
All right. Be well. Bye, Al.